Hey everybody, it's Ian Beamer with Guaranteed Rate. Hope you're doing well. Hope you're enjoying your summer. The Cubs about to sell everybody worth a bag of balls once again. So this is a little traumatic. Same thing as last year. Hopefully next year we can field the team. But it's not why we're here. We're here to talk about the mortgage markets, the housing market, the Fed met again this week and just like last month raised the federal funds rate another 3/4 of a point. So we're up to 2.25 to 2.5% on the federal funds rate. And mortgage rates are staying flat and maybe even improving slightly. So why would that be? Well, the Dow is doing better. People are buying bonds, investors are buying bonds, and investors are buying mortgage-backed securities. So apparently nobody else is real concerned with this most recent Fed hike, and the thought process is that we may be headed towards a recession. Although employment rates, the employment rates seem to stay very high. Unemployment is around 3.6%. So it's hard to think of a recession when unemployment is so low, but mixed signals. Mixed signals. We do have an inverted yield curve. We've talked about this on a few videos in the past. The 2-year U.S. Treasury bond has a higher yield or rate or return than the 5-year, 10-year, or 30-year U.S. Treasury bond. So that's typically a sign of a looming recession to come soon. Anytime the shorter term interest rates on those bonds are higher than the longer term interest rates. Talked about that in the past, so I'm not going to dive into that too much. But nonetheless, if we are headed towards a recession, what does that mean? What does that mean for the housing market? What does that mean for interest rates? Well, typically, if we do head into a recession, that means in order to get us out of the recession, the Federal Reserve Bank will have to start lowering interest rates to spur the economy again, get people borrowing money, get money liquid again. So if your argument, and we've already discussed ad nauseum, the fact that inventory is very limited, although demand is being curbed by these higher rates. And that's the goal of the Fed right now: raise interest rates, slow down the borrowing of money, slow down spending, get home prices under control, get energy prices under control, oil prices, gasoline prices. We've already seen gas come down slightly. Those of us that have been paying attention, but it's still up quite a bit from a year ago. I think we're up over $1.30 per gallon from just a year ago. So although we're down 50, 60 cents, for most of us in the past 30 days, we're still up quite a bit from 12 months ago in terms of gas prices. So home prices continue to appreciate. Nationally, we're starting to level off. We're starting to see inventories grow, maybe slightly in the Chicagoland market. Months of inventory, which we've talked about in past videos. Nationally, we're about 2.6 months of inventory. And in the Chicagoland market, we're still around 1.7 months. So again, a stable market, a healthy market would be 5 to 6 months of inventory, which means if you list your home, it'll take you 5 or 6 months to actually sell and close on that home. Right now, homes continue to get multiple offers. About 55% of home offers are still above asking price. But the average number of offers per listing is dropping slightly. So we're about 5.5 offers per listing in April. We're down to about 5 in May. And then the June numbers tell us we're getting about 4.5 offers per listing. But homes continue to appreciate. We're averaging about 8% here in the Chicagoland market, 8.2%, I believe, which is still much higher than the historical average. So the historical average somewhere around 3 or 4%. So we still have work to do to get home prices under control. So my guess is they're going to keep raising interest rates, get gasoline down further, get energy prices down further, and get home prices down further. So expect more of these rate hikes in the near future. As far as mortgage interest rates, again, if the consensus seems to be that we're headed into a recession, mortgage interest rates may level off, may even dip. But it's hard to imagine mortgage interest rates dipping significantly, and obviously demand for homes would then increase. Supply for homes is already limited, which would lead to even more appreciation in homes. So that can't continue. It just at some point has to stop. So I would have to think that interest rates have to come up, but that's not my call. So I did include a graph that shows you the last 6 recessions that we've had, what happens to interest rates during those recession periods. And then I included another graph to show you what happens or what has been happening as far as inventory levels in the Chicagoland market. So inventory levels are still record lows. Demand is still very strong. So I would think homes will continue to appreciate at a faster than normal pace. For how long that's going to continue, we'll see. But again, the goal for Jerome Powell was about 2% inflation. I'm not sure we'll get homes down to that rate. If we can get them down to 3 or 4%, that'd be a more stable market. So I think that's going to be the target. Let me know what you think. Let me know your thoughts. Appreciate you checking out my email and my video. Look forward to hearing back from you soon. Have a great day.